IAS 32. First, we need to determine what is a financial instrument. Now, this will be a contract between two entities, where this contract gives rise to a financial asset in the record of the one entity and a financial liability or equity in the records of another entity. Now, when we look at a basic example, we have A Limited that provides a loan to B Limited. In A Limited, we will credit our bank as our bank decrease, and we will debit a loan receivable. This loan receivable will be a financial asset in the records of A. When we look at the records of B, we will debit our bank and we will credit a loan payable. And this will be a financial liability in the records of B. Now, it is extremely important that you need to identify from the issuer's perspective on how to classify the financial instrument in accordance with the substance of the contractual arrangement and the definitions of the following. Now, a financial instrument can either be 1. A financial asset. Now, guys, you're able to link this to your conceptual framework. If this is an asset, this should result in future economic benefits being received. Therefore, the entity that recognizes a financial asset should receive cash, equity instruments, or any other right from that financial asset. When we recognize a financial liability, the first thing that you need to think about is the word liability. There has to be an obligation to deliver. Then equity instrument, this will be the residual interest in an entity after deducting all of its liabilities. Then IAS 32 indicates to us that there can be compound instruments. This is an instrument where we have a financial liability portion where there is an obligation to deliver as well as an equity portion. Convertible preference shares can be compound instruments. The fifth definition is our treasury shares. Now I'm going to explain this by means of a basic example. When we register a new company with Sub-C, you will identify, and I'm pretty sure that you have experienced this during your articles, or you will still, that you will have to keep a share register for that entity. When you register the entity with Sub-C, you need to register the authorized share capital. Now, this is the number of shares that the entity may issue going forward, but this will be the maximum number of shares. Therefore, you will identify in a set of financial statements that the authorized shares will normally be something such as 100 or 1,000 or 10,000. And then our issued share capital will be the number of shares issued from the authorized share capital. And this will be, for example, 100. Therefore, the journal entry will be to debit bank and to credit share capital with, for example, 100 shares at R1 each. Now, when an entity reacquires its own equity instruments, they deduct the purchase price from equity and no gain or loss shall be recognized. Now, what does this mean? A treasury share is when the entity reacquires. Therefore, they buy back. For example, they've issued 100 shares initially, and now they decide to buy back 50 shares. And our journal entry will be to debit share capital and to credit bank with 50 Rand. then there might be instances where it is difficult to identify if the credit side of the entry is either a financial liability or an equity instrument. Now IAS 32 prescribes us with principles. How do I determine if the instrument issued is a financial liability or an equity instrument? Remember, you need to look at this from the issuer's perspective. Your first question is there a contractual obligation to deliver cash or a financial asset? Now guys, when you think about your conceptual framework, your definition of a liability is that there has to be an obligation. Now when you ask this question, is there a contractual obligation? And your answer is yes. You need to know that you will have to recognize a financial liability. If your answer is no, you need to ask the next question. Will the contract be settled in entity's own equity instruments? If your answer is yes, you need to ask question number 3. Will the shares be variable? Yes, this will be a financial liability. Will the number of shares issued be fixed? Then this will be equity. If your answer to question number 2 is no, the contract cannot be classified as equity or liability. Let's look at a basic example. You have the example on the bottom of your page. Now at the bottom you will identify that we have entity A that provides a loan to entity B in cash. Now as per option 1, the loan is provided in cash and entity B has to repay the loan in cash. Therefore, when you look at our questions, question number 1, is there an obligation to deliver cash or financial assets? Yes. Therefore, immediately we can identify that this is a financial liability. Option number 2. The loan is provided in cash and entity B repays the loan in its own equity instruments. Therefore, when we ask question 1, is there an obligation to deliver cash or financial assets? Our answer will be no. Next question. Will the contract be settled in the entity's own equity instruments? This is where it will be extremely important that you read the information provided. If the answer is no, this contract cannot be classified as equity or liability. If the answer is yes, you need to ask question number 3. Preference shares. I have identified that there's a lot of students that do not know the characteristics of preference shares. Please, you need to study this. When they indicate to you that this is a cumulative preference share, you need to identify 2 things. The first, that our ordinary shareholders will not receive any dividends until we have declared to all of our preference shareholders. The second important thing, if you have not yet declared to your preference shareholders, you will have to provide for this expense that you will have to pay dividends to your cumulative preference shareholders. Preference shares can have 2 cash flow streams. The first will be the preference dividend and second the capital portion. Therefore, it is important that you identify that preference shares can either be 1, a financial liability or equity, or 2, it can be compound instrument. Now, what does this mean? It can have a portion that is a liability and it can have a portion that is equity. Therefore, this is an. Option 1 financial liability or equity, or option 2, a compound financial instrument. I've included a few important definitions. The first definition will be a derivative financial instrument. This will be a financial instrument or contract with all three of the following characteristics. Now, I'm going to explain this by means of our picture. This is a financial instrument contract. Our financial instrument will change in response to a change in another variable. Therefore, guys, this can either be interest rate, foreign exchange rates, index prices, and so forth. So what we are saying is that this is the underlying. Our instrument will change due to something else changing. Our second characteristic, there does not have to be an initial investment. Therefore, guys, what does this mean? There does not have to be an initial cash inflow for this to be a derivative financial instrument. And our third characteristic, this will be settled at a future date. Again, our arrow looking forward. You need to remember this is all three of the characteristics. 1 plus 2 plus 3. Examples of derivative financial instruments will include share options, FEC contracts, and interest rate swaps. Now let's have a look at a share option. What is a share option? This is a right to buy or sell shares at an agreed price at a time in future. This will be, for example, when the entity provides a right to an employee to buy or sell shares at a time in future at an agreed price. Share options are not shares. They are a right to buy shares. Now let's link this to our definition of a derivative. First definition, the value should change in response to a change of an underlying variable. Now, our employee has the right to purchase shares. Now, this right at a specified price. The specified price we will refer to as the exercise or strike price. Now, when we look at characteristic number 1, you need to identify that the value of this right will change due to the change in our prices. However, guys, the value of the exercise or strike price is an agreed price. That is important. It's an agreed price. But the total value of the share option that this employee has will change due to a change in a variable. Number 2, no initial or small investment. Guys, this employee did not have to pay anything initially. And characteristic number 3 will be settled at a future date. Self-explanatory. What is a forward exchange contract? I know that hedging is excluded. But guys, when you register as a CA, I do expect that you know what is an FEC. I'm going to explain this by means of a basic example. We have entity ABC Limited. Entity ABC Limited purchases goods from US Limited and pays $100 for these goods. We have a transaction date, a year end, which will be 31 December 2016, and our payment date will be 30 April 2017. In this contract with US Limited, entity ABC Limited has to pay $100. Therefore, our transaction will be to debit our inventory at what value? Guys, at spot rate at transaction date, and to credit our creditor at spot rate at transaction date. At year end, in terms of IAS 21. Now I know that this is for our level 2 students. Our level 1 students do not need to know IAS 21 and previously did not need to know hedging. Now guys, when you register as a CA, I want you to know what is an FEC at least. Therefore, please focus and ensure that you understand my basic example. Now, at year end, in terms of IAS 21, we need to remeasure our creditor at spot rate, and the difference shall be recognized in our foreign exchange gains and loss account in our profit and loss. On payment date, do you agree with me that we will have to pay US Limited $100? Therefore, step 1, in terms of IAS 21, we will have to remeasure our creditor at spot rate. And number 2, you need to recognize your payment journal. Now what happens is that ABC Limited do not know what the exchange rate will be on payment date. Now guys, I'm sure you are all aware of the heavy fluctuations that we had the past few months. Unfortunately, we do not have a crystal ball. Okay, so Entity ABC Limited decided to enter into an agreement with the bank to buy dollars at an agreed rate. For example, at 10 Rand per dollar. And on payment date, ABC Limited will receive this agreement, the 10 Rand per dollar. They will receive $100, and in return, they will have to pay 10 Rand per dollar. Now, the problem with this is, guys, that we do not know what the currency will be on payment date. Therefore, the currency can be less or the currency can be more. What you need to know is that this section will be our financial instruments section. And the journals will be in terms of our IAS 21 rules. Then number 3, our interest rate swap. What is an interest rate swap? This is a liquid financial derivative instrument in which there will be 2 parties that agree to exchange interest rate cash flows based on specified estimated amount from a fixed rate to a floating rate or vice versa. We have A and B. A originally had an agreement for a floating rate, and B originally an agreement for a fixed rate. And now they decide that they want to exchange. What is a non-derivative? This is an investment in equity and debt securities, trade and other receivables, cash and cash equivalents, loans and borrowings, and trade and other payables. Now guys, do you identify that our financial instruments can be classified into derivative financial instruments and non-derivative financial instruments? And this will be our normal financial instruments, trade receivables, cash and cash equivalents. I have included the definition of debenture. Now, why did I do this? You all know my first language is Afrikaans. Therefore, every time when I work through an example or a question that includes debentures, I need to quickly think about this. What is a debenture again? Now, I know that there's a lot of you that English is your second language as well. Therefore, I've decided to include this. Now, it's actually pretty easy. A debenture is a form of a long-term loan. Therefore, it's a debt instrument used by companies to raise money for a medium to long-term period at a specified rate of interest. The debenture can either have an end date or the debenture can be for an indefinite future period. Therefore, this does not end. Okay. Entity B required cash. Therefore, they've decided to issue a debenture. Entity A took the debenture. Therefore, in the records of Entity B will debit bank, cash received, bank increase, and credit a debenture. Entity A will credit bank as they provide Entity B with a cash and debit a financial asset being the debenture. Now, what is important, guys, with the debenture? Remember the interest. Therefore, Entity A will recognize interest received and Entity B interest paid. Settlement options. What does the word tell you? There is options on how to settle the amount. These options can either be for the issuer or the holder, and they will have the choice over how they want to settle. When you look at this, remember we have indicated that it is difficult to identify if the credit leg is a financial liability or equity. When a scenario indicates to us that settlement will be fixed or have a fixed value, immediately you need to identify that this will be an equity instrument. Remember the questions. Question 1, is there an obligation to transfer cash or another financial asset? If your answer is yes, you need to know that this is a financial liability. If your answer is no, we need to ask ourselves the question if the entity will issue its own equity instruments. Now I'm just including shares as a share is equity instruments. If your answer is yes, we need to identify if this will be variable or fixed. If it's variable, you need to know that this is a financial liability, and if it's fixed, this will be equity. Remember, guys, I make use of this triangle for variable. Again, abbreviations that I have used throughout our notes and lectures. If the share option, where the issuer can decide to settle the share option either in cash or its own equity instruments in exchange for cash, and these instruments are variable, then it is a financial liability. Remember settlement options. The issuer or the holder can choose.